Looking for the best opportunities in Perth property? Get the local area expertise you need from Momentum Wealth, WA's trusted property investment consultants. Market insights, advice and representation from award-winning buyers agents and REWA Hall of Fame inductees. Visit Momentum Wealth's website at momentumwealth.com.au to organise your obligation-free consultation today.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Okay, everyone, how you going? Welcome to the Smart Property Investment Show as we navigate property investment in what is a bit of a, I don't know, I call it a crazy market right now. It's a pretty good market, most investors I'm speaking to, but it's a market in flux, and flux normally has a negative connotation, but flux also has a positive connotation. So that's what we've been chatting about over this last period as COVID-19 has hit us like a freight train, and as a nation we start to emerge, I'd like to think, out of it. Borders are open, planes are flying, people are going on holidays. There's a buoyant mood over the festive period. People are happy to get on the beach and start taking it easy and relaxing. But a lot of Australians are thinking about wealth creation. A lot of people, I think, have become a lot more intrinsically connected with their financial health as a result of COVID, and they know that old adage of plan for a rainy day. Well, guess what? We've just had a big rainy day, and those people who have planned and were prepared for COVID-19 have done pretty well through it. Those who weren't so planned have probably hurt quite a lot and been living off the teat in many ways of the government, whether it's job keeper or job seekers. So hopefully a lesson for everyone. Plan for that rainy day, and planning for a rainy day means that you got a few bucks in your back pocket should the proverbial hit the fan. So lots of lessons for everyone. Here on Smart Property Investment, very much my job is to curate conversations with people who have had lots of life lessons, whether they're property investors or people that work within the profession of property investment. And that's my job, navigate those conversations. Hopefully I can extract some gems of information to help you be a better property investor. I'm not going to be able to achieve that today because the guy I got in the studio doesn't know nothing about property. Paul Glossop from Purepropertyinvestment.
I know something about double negatives.
Double negatives. I'll give you a hard time. I do lean on you, Paul, for commentary and insights into property investment. And I think that's a fair introduction, saying I think most Australians now know that just be ready for stuff that you can't control.
Yeah.
That's the secret.
Massively. Always be ready.
Most of your clients, have they been okay through it all? Has anyone sort of really blown their dough and ended up on, it's not like the Hungry Mole down there by Bangaroo where people used to line up to get a feed and try and get a job, right?
It's far from it. And I don't want to trivialise it.
Depression, yeah.
Yeah, but to be completely fair, early in the piece, and I'm talking probably April, May, June, July, I definitely had clients who we were searching for, who we then put on pause as far as searches, and then after having follow-up discussions with them, said that they lost their job. And that's serious. And it really was serious. And I think out of that, there's still a number of these people who are going to sit there, and a portion of the population who are still in that position. So I don't want to, trivialise and say, money's
done it hard, man.
Absolutely. And they still are going to. And I think there's going to be careers that are going to change out of this forever. Yeah. And there's going to be family dynamics that will change out of this forever. But if I take the doom and gloom side out of this and talk about where the positivities lie, they are certainly there, and they're beyond where we were at the start of the year.
So the point is, and this is specific for property investors, we're not talking all of Australia here. We're talking about those Australians who are looking to create wealth through property. Some of them haven't yet started doing it, but they're educating themselves. Some are in the middle of doing it. Some are at the back end of it, right? They're looking, okay, well, what do I do with this stuff right now? But talking about planning for a rainy day, putting the horrific impact of some industries through COVID-19 aside, but planning for a rainy day as a property investor means building the right portfolio so that irrespective of market conditions, irrespective of economic conditions, irrespective to a certain degree of your personal financial position, your property portfolio should remain relatively solid and serve a purpose for you. So it's only for property investors when things go absolutely wrong that they've got to start selling off properties, and that's bad. That's what we're trying to avoid as property investors, right? Did you see much of that?
Definitely not.
No.
If anything, I probably saw people surprised on the positive note on both.
So we're talking about resilience here.
Massively. Yeah. And correct portfolios. And you literally, whether you intentionally did it or not, I assume you didn't because you average at podcasting, is that the curation of that information is pretty much, that's a definition of what I think is a successful investor, is essentially building a portfolio which is effectively over time, it is not reliant on you to dictate its performance.
It's a really important point, resilience. And I think a lot of people use it in an emotional sense. They go emotionally resilient, i.e. stuff happens to you, you cop a couple of punches, you can weather the storm, move on and progress. When you look at COVID-19, and today, by the way, it's going to be a Q&A episode, and it's sort of connected in with it, but when you look at COVID-19 and you look how Australia's fared compared to other states, what you talk about is resilience and economic resilience, and the resilience of individuals, the resilience of humans, resilience of industry segments, resilience of the government, resilience of the mechanics of government, RBA, Treasury, all these different departments, and this attitudinal resilience, which I think has been inherent to Australia for its birth, right? Like Australians sort of, she'll be right, we'll get on with it, no worries, mate, right? And some people have struggled and it's been tough through that, and there's a lot of support for those people, thankfully. Again, that's resilience, right? So, but the resilience of our banking institution, the resilience of our economy, and the resilience of the property markets to give a sense of wealth for Australians has helped quite a lot. So when you put national resilience to one side and you put in personal resilience to your property portfolios, it all lends itself to it. So the more Australians with better property and resilient portfolios, the more resilient the property market and therefore the inherent value of property and asset class moving forward. Yeah. So little pockets of resilience gives collective resilience, which lends itself to a better and stronger Australia. That's what we've just gone through.
Absolutely.
So in many ways, for smart property investment, to help people build resilient portfolios that can stand the test of time is what we do.
Yeah.
Paul Glossop is a buyer's agent, property strategist. You're in the business of helping people build portfolios that create wealth, but if stuff happens, is resilient so that wealth effect can continue irrespective of the market.
Bang on, Phil. I don't need to add anything to that. And I think, so an analogy that comes to mind when we're talking about this is essentially like raising children. You've got young kids, I've got young kids, and a lot of listeners no doubt have had children and obviously siblings and other things that come in their lives. But essentially you have a lot more attention, a lot more need earlier in the piece. They need more money. You need to save more money. They take a lot more time. They're a lot harder work until you actually raise them to the point where your intention is that they become self-sufficient. And good property portfolios are effectively geared that way, where you know that, yes, I put effort and time into it initially. It probably won't take 18, 25, 30 years to get to maturity. It'd probably be more like maybe in a good fast case, 2 or 3 years, in some cases, maybe 7 or 8 years, but you're trying to build it up to say, eventually take me away and you do what you've got to do, which was my intention from day one.
That's a really good analogy. You got to nurture your property portfolio like you do need to nurture children. There's a Chinese proverb around, the best tree was the one you planted 20 years ago. I don't know exactly what that was, but anyway, so that's just a bit of psyche into the reason why property is such an inherent part of Australia's identity and our economy and why we continue to grow. So, hey, play your part and build resilient portfolios. So that's where I'll conclude that. But Paul, Q&A episode, and it's good to have you in. I do enjoy these type of things. It's always good to break down and getting an insight into what our listeners are concerned or thinking about. So I've got 3 questions here. And the first one is from Patrick C. And he writes, I won't say his last name. He wanted to be a little bit anonymous, but he lives up on the northern beaches of Sydney. And he writes, Paul, and I'll paraphrase this because it's a long verbose question, but I'll crystallise it. He's saying he's been planning for multiple holidays in 2021. He sort of talks about the 3 or 4 surf trips he takes every single year and how he likes to go to fancy holidays with his families, but he can't travel at the moment. So He wants to know, should he be keeping that money aside and waiting for borders to open and go and enjoy himself, or should he be parking that money in property right this time? So invest it or spend it or wait for a rainy day, or what can you do with that money? Is there some sort of short-term place you can do with that to get some utility out of it so it's still available for you into the future? It might just be putting in an offset account or something. Maybe. What do you reckon? Really good point there. I guess if Patrick's already got a mortgage and it's got an offset facility and he's got outstanding debt and he's got, let's say hypothetically, 50 grand that sits there available for a couple of family holidays or a surf trip or whatever he wants to do with that money. And the reality is there's actually a lot of people in that position who are positioning themselves for the last 12, 24 months to go and do something. And those plans, and another example, people who are planning weddings for 2020. True. Big money and big money. And a lot of people now are maybe not even saying, I'll delay that to 2021. They are even considering, do we just do something a bit smaller and a bit more confined? And that actually means that we don't have to spend half that cash that we had. 2 things, really easy one, as you said, park it in your offset. Ensure that you've got an offset facility and make sure that that money's actually earning you. A lot of people just have that money sitting lazy. Explain it. So what you're talking about is rather than plugging that into a property, which is largely illiquid, if you already have property, it can help minimise the amount of money you're paying on your mortgage. That's what we're talking about.
Absolutely. As simple as it comes, where, say, you've got a $500,000 mortgage and all of a sudden we've got $100,000 that we have sitting in a separate savings account, not in our offset facility, offsetting that $500,000. If we take that $100,000, have an offset facility against our $500,000 mortgage, that mortgage is costing us 3% interest per year. Essentially, that's $3,000 that we should otherwise have in our back pocket net after tax with doing absolutely nothing with that money, which for most, and that's year one, if you compound over that over the year of, or the life cycle of a mortgage, 20, 30 years, you're talking exponential amounts of money. You're talking in vicinity of potentially 60, 70, 80, $100,000 of additional cash that should be available to you just by actually doing something sensible with that. So with that, very easy one. That's choice one. You could just say, put the money into an offset facility, please. I've spoken to a lot of other people who've got somewhat creative earlier in the piece too, talking about things like investing in short-term share portfolios, shorting stocks, etc. Completely out of my remit, and I'm not going to advise that because I have zero or close to zero knowledge on where and how that sits, but you talk to someone who's a trusted advisor in that space. However, if the option is saying, well, is this the right time for me to say, well, I've got a deposit. If I've got borrowing capacity available, that money was otherwise going to be utilised for something else. As a time, if we would talk over the last 5, 6, 7 years, this is probably the best time that you will see over the next decade to make that short deposit, hypothetically at $50,000 at 10% LVR, plus your closing costs about a $400,000 property. If you've got a $400,000 property, which you're able to get into it with a $50,000 deposit, if that property performs by 20% growth over the next 3 or 4 years, and I would be not going to say unequivocally it will be, but you're probably in the best time of the cycle where you're going to get that type of return. Your $400,000 property is worth $500,000 in 3 years' time. Your $50,000 made you $100,000. Essentially, you're getting a very, very big return cash on cash.
So you're saying do that and then have a better holiday somewhere
then
else.
You can go and take that money out of that potentially out of that facility and go utilise that. And not to say it's going to be tax deductible or advisable, but you're going to actually have that $50,000 turn into much more and still have the ability to go and do what you want if you've invested correctly.
Yeah, and it's a good point there. By the way, quick disclaimer, we're just having a discussion around these things. It's not advice by any means. It's
not
just
at all.
A couple of guys sort of saying what we would do, but everyone's circumstances and situations are very different. So make sure you speak with a trusted financial advisor before making any decision. And, you know, if I was Patrick C, can't speak to your accountant, speak to a broker, get a sense for the market, keep listening to podcasts. But you should have holidays though, Paul, shouldn't you?
Absolutely. That's what it's all about in the end.
It's good. We're going to go a quick break. When we come back, we'll get into our next question back in a moment.
Whether you're an avid property investor or about to buy your first property, why do it alone when you could partner with Australia's best buyer's agent? Director of Pure Property Investment, Property Investment Professionals of Australia board member and REB Buyer's Agent of the Year, Paul Glossop, can take your portfolio to the next level. Get in touch today to discuss your investment goals. Get one-on-one insight from Paul Glossop. And for the first 100 people, this service is completely free. Head to purepropertyinvestment.com today to schedule your consult with Paul Glossop directly.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Paul Glossop from Pure Property Investment. Paul, a question here from Troy F. from Chipping Norton.
Chippo.
Okay, are you allowed to call it Chippo?
Absolutely. They would affectionately refer to it as Chippo.
Chippo. Where's Chipping Norton?
Southwest Sydney, essentially, just off the Georges River. Yep.
Okay. Waterfront.
Could be. It's also quite flood prone, so it could be waterfront at different times of the year, depending on the year. La Nina we're in at the moment might be a little bit more waterfront around.
Waterfront is good waterfront.
Not in that case, no. But it's actually quite a nice affluent area.
Does it actually help me talking about Chipping Norton? I'm trying to work out my geography. So you're talking about Bankstown Airport, right?
Not too far from that. Yeah, okay. You're talking Moorebank, where the big Moorebank, the intermodal is going to be. Yeah. It's going to take the containers from Botany Bay out towards the southwest of Sydney and then deploy it from all the different highways and corridors from there as well. Okay. Big investment in the big ends. So does waterfront out there matter? Like, is it prestige? Oh, there's riverfront.
Riverfront's cool.
Absolutely.
A bit sharky out there. People do
good bull shark. There's a lot of water skiing.
Water skiing.
Yeah.
Okay. All right. Thanks, Troy F. from Chipping Norton. Got one of those things for sending a question. He asks, it's pretty simple, I guess. Every property investor's thinking about this. Where do I invest right now for capital growth?
We've covered a little bit of this, I think, previously, you and I, Phil. And if I'm looking at buying here and now, and we're talking for 2021, 2022 kind of capital growth and more of that immediate term, I think we're going to be in a unique scenario where the markets in general are going to do better than they have over the last few years holistically, or even the last 5 to 8 years holistically. But if I'm talking your major markets, which I think you're going to get the best outcome in basically any price bracket, but let's hover around that let's say $300,000 to $800,000 price brackets. I would say stick to freestanding houses. I would say that if you're going to talk about two major markets, I would suggest freestanding houses in Perth, freestanding houses in parts of Brisbane are probably going to be your two best major capital cities, which I would expect you're going to get best capital growth and cash flow on. I think Adelaide's going to do quite well. Canberra's going to be consistent, but Sydney and Melbourne, obviously that price bracket's going to be more difficult. And that's your biggest challenge, is those markets will do fine, but they become cost prohibitive. And really, when you're talking freestanding, $600,000, $700,000, $800,000 is probably, we're still buying in Sydney and Melbourne in those price brackets, but it becomes very difficult. So top two, I'd say freestanding Perth, freestanding Brisbane. Stick towards the flood-free, non-flood prone areas of Brizzy. Make sure you're looking at your soil tests for Perth. There's different areas in there where you need to be concerned or consider what the actual soil makeup is, as well as things like building and pest inspections, termites, those types of things, quite important in certain areas there as well.
So I'm going to use my privilege to ask an adjunct question to that, which is the opposite of it. Broad brush, blanket, where shouldn't I be buying, or what shouldn't I be buying?
I wouldn't be buying
office buildings, maybe.
Office buildings.
Yeah.
I wouldn't. Yeah, definitely wouldn't be a strip mall retail. Anything that's associated with that type of stuff. Commercial stuff. I would definitely be avoiding, and you're going to see a glut of off the plans. And personally speaking, I think this is where we're going to see the danger, is that when you see these rising markets, you see that a lot of spruikers come out with a lot of these fancy options with a lot of guaranteed rents. Things around the National Disability Scheme, when you're talking about that type of scheme and the new properties and products that are being rolled out there, I see a lot of danger in some of those certain properties which are way overpriced because they've got this huge rental guarantee attached to them. Any of those markets which are associated with those new town centres and those small little 1 and 2 bedders that sit with those town centres, they're the types of properties, regardless of where you're buying right now, that I would say over the next 5 years, they will underperform the market hands down.
And we spoke about this podcast we did recently around in markets, and I think it's going to be universally, to your point, but thinking back on the conversation, a universal multi-regional uplift in property price movement, capitals and also regionals, right?
Yep.
And I think the point that you made during that chat was, just because markets are rising, good assets will grow faster than less than good assets. So what you're talking about here is that just because your property has gone up in value in a market that's booming, just because you're in the market, you've got to be thinking about plugging your money where it's most effective. So, if you buy an asset like this, which will probably grow in that market, but it might only grow by 5%, when 2%, whatever it is, when the same money in a different asset in the same market, same location, might go 20 or 30%.
Absolutely.
So this is the point, right?
Yeah. And it's also what happens once the market's finished, the growth cycle's finished, because it doesn't continue. And that's where you got to build the moat. And for me, that's really where people have got to think both, A, how do I get the most amount of growth in the shortest period of time? But when that growth stops, which it will, and it happens, this is why cycles can exist and continue to occur. Where's my defense?
So the negative on that then. So if you buy well in a market that's moving upwards, you would like to think that, yes, you're going to get capital value, but at that point in time when that growth stops, that you have a property which is neutrally or positively geared and it's in demand from tenants, right? So if you buy a one-bedder apartment in an area which has got hundreds or thousands of one-bedroom apartments, you might get some capital growth, not as much as a different type of asset, but at that point in time when the growth stops, it might be negatively geared. Your rental guarantee might have gone. And you might have a huge vacancy rate, so no one wants to rent your thing.
Absolutely.
That's when that thing turns into a less than nice asset.
Massively. And that's your danger, is that what stops a market from growing? Typically, it's going to be things like more expensive money, additional supply. If those two things alone happen to a property, which you don't have a good answer to say what happens when those things happen. A, you've got a lot of fixed costs, i.e. high strata, high running costs. If your interest rates go up because the market's actually stalled, that's what's causing it and affecting it, as well as additional supply, because that's what typically happens on the back end of the boom. Then that's really where people are left hugely with those issues.
Okay, another question here, Paul from Purepropertyinvestment. How's that? Yeah, you guys going? You must be busy at the moment.
It's a manic time. As busy as.
And why is that?
Been.
Just like what we spoke about in that earlier podcast we did a couple of weeks ago.
I'd like to say that we work with a lot of sophisticated investors, and I think because we reach about 20,000 people a week just through Pure Property Investment alone, via our website, via our emails, via our communications, and that's a lot of people. And we've got a community of people who literally I think are very, very well informed, and they know when the time is right, they need to take action, and we're seeing that on droves right now.
So make hay when the sun's shining.
Massively.
The sun's shining right now.
Absolutely, it is.
All right. Not everywhere. It's still a bit gloomy and stormy in some places, but Someplace good. Michael C. from Brighton down in Melbourne, out of lockdown. Welcome back, Michael, to Australia now that the borders have opened up. But, you guys have done pretty tough down there. So good work, staying the course. And, to our friends and colleagues down in Victoria now, they've had, last time I looked at it, nearly a month of negative COVID cases.
Yeah, I think it was 33,
and no
34 consecutive days last we looked.
Irrespective of what you think of the government and how it's acted, at least the outcome has been a positive one. Eradication largely of the COVID-19 virus. But this one's connected in, Paul, with, by memory, it was sort of late November when the state budget was down in Victoria, and we saw it, there was a couple of days after what happened in New South Wales, all this discussion around changing up stamp duties, right?
Yep.
And Michael asked the question, considering these changes, should he buy now or should he wait for this stamp duty changes, which I think down in Victoria, they're abolishing it completely and they're implementing, know a little bit more about the policy down there.
Yeah, it's a 25% discount on established, 50% discount on brand new.
Okay.
Yeah.
So do you buy now or do you wait until this comes into place? Because this is about the portability to trade in and out of property without having the excessive overheads of stamp duty. Now, let's make this point, right? This is not the government saying, hey, you don't have to pay this tax anymore.
Exactly.
Because governments
they're not changing
do what they do with the money that people like we give them.
Exactly.
So governments, state governments, not federally, and there's a big argument around they should be getting, well, they get a bit of GST stuff, right, in other ways, but state governments make most of their money through stamp duty, land tax, and payroll tax.
That's it. There you three.
And I get
the rest of it's immaterial.
on
all of them.
I should get the key to the city.
I call you Kirabilly Phil.
So that's how the governments make money for them to be a government, right? So they need cash, right? So this is just changing the speed at which you're probably paying your stamp duty, right? So the question is from Michael, wait until it comes into effect or go now?
Yeah.
How do you work it out?
I'll tackle this on a few different angles because Victoria versus New South Wales versus the other states, as them when they go through these amendments, these policies don't all look completely uniform. So if I do take into account, for instance, New South Wales, it hasn't been implemented yet and they're still going through discussion phase. But their potential discussion is we abolish your stamp duty and we replace it with a flat-based land tax or an opt-in of stamp duty. So they're actually coming to the table with the option to say, we give you the option, you say you pay your stamp duty up front, which on average is about 4%, or we give you the option to pay, if you're an owner-occupier, a much lesser flat-based land tax on the value of the property, or alternatively, if you're an investor, you pay a flat land-based tax on the value of the land itself again as well. And you get the option opt-in, opt-out. Here's the best piece of advice I could give, and we've done some analysis on what that all means if you're going to opt into just buying and paying stamp duty versus paying this land tax, owner-occupier versus investor. The magic number is 12 years. 12 years is your break-even point. So if you hold the property for less than 12 years, you're better off not paying stamp duty. That's generally speaking in the New South Wales proposal. If you're holding it longer than 12 years, then essentially where that money comes in and goes on the percentage of the actual land tax that you'll be paying versus paying stamp duty, if you're holding it longer than 12 years, you're going to end up paying more money as a flat-based fixed tax for the life of that property. So it comes down to what your intention is of this property, and that really is what has to be considered when people are investing or buying that owner-occupier, as well as if you're going to sell a property which you've already paid stamp duty on and go and redeploy that into something which you're going to go be your next 25-year forever home, and you're going to choose not to pay stamp duty because you're going to save, for instance, if you buy a $2 million property, you're going to save $80,000 that you don't need to come up with. That's a lot of money.
Yeah, it could change the property you buy.
Exactly. So, and that's the part which people need to know. What is your intention? And that roughly that 12-year cycle, that 12-year time frame of your break-even point is what is the consideration. But if you're going to sell a property to go into a non-land tax based, you've got to remember that your property you've already bought is grandfathered. So this won't apply to you. So if you get rid of it, you lose that in that property, and then you go and enter into a property which you forever will be literally paying money, regardless whether you're an owner-occupier or an investor. And that's the important part too, is that this isn't just targeting investors. This is going to be everyone.
So it sounds like you probably should speak to your accountant when it comes to this sort of stuff.
I think your accountant, and also from what we do, when we're looking at strategy and we're looking at the implementation of why you're buying this property and what your intention is that that's what we've got to do, is that we've got to consider why you're buying it, how long you're going to hold it for, what's the intention long term, and we've got to say, where's the cash flow sit? Does it make more sense to sell that property or just leverage the equity out of that property and then go buy that next investment versus selling and buying and trading? There's a lot into it.
Okay, good. We're going to another break. When we come back, a final question back in a moment.
Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome back, everyone. Phil Tarrant, Paul Glossop, going through our Q&A episode on the Smart Property Investment Show to our fourth and final question, Paul. Now, this question, anonymous, and I can probably understand why you want to be anonymous on this one. And this person, Mr. or Mrs. Anonymous, thanks for writing in, writes, it's quite, again, a bit of a long-winded question, but I'm going to summarise pretty much. Their mortgage broker, Paul, keeps telling them all the reasons why they can't get a loan. So the question is, how do they know whether or not their mortgage broker is any good? This is a universal question, right?
Yeah,
Do you keep going, because right now everyone's going, I want to buy, get pre-proven, all that sort of stuff.
Yeah.
But you just keep getting told by your mortgage broker, no, can't do that, can't do that, can't do it because of this reason, can't do this because you're on loan holidays for a period of time, can't do this because, you're having a child in 6 months' time and I know about that and therefore you're not going to. What do you do if your mortgage broker keeps saying no?
It's a really broad question, but I think it's so important because it stops people, and some people get told it's like seeing a doctor and getting an opinion, unfortunately. And I'm not going to say that medical professionals give bad opinions, but ultimately when it comes down to it, their expertise and knowledge in a certain area will dictate what they provide as recommendations. And brokers are absolutely no different, is that you've got experts in owner-occupiers, you've got experts in investment, you've got experts in commercial, you've got experts in self-employed, you've got experts in self-managed super funds, and you've got generalists. And unfortunately, the generalists are typically the ones who will give that opinion if it falls out of what their remit is, whether you've got a dependent or you're expecting a child or you've gone on a loan holiday or loan deferral holiday for 6 months and they don't know which banks for policies fit into, okay, you know what, don't worry about it, we can refinance to this bank because they actually don't have that policy. Or you're buying a commercial property and you own a business and you're the sole director of the company, but your wife is the sole director of the trustee, and therefore you fall into that policy, which is low doc, and you actually can't get that loan at all, where they realise there's different banks who have different policies. I could rabbit on about that all day.
So it happens all the time?
All the time, literally all the time. And the amount of people who make no arrangements or take no action because they're told by one person that you can't do anything and take it as gospel puts them behind the eight ball. And not just now in the time where you've got a rising market, but ongoing. They say you can't do that, you can't do that, you can't do that. Or even if they say you can do that, but it's that you're doing it this way, they might say you put it into a policy or a product that is far more expensive than it should be. Quality brokerage advice is in the top 3 pieces of support that any successful investor will say that they've always had. And if you haven't got it, find it.
Yeah, I agree with that. And it's important as an investor or anyone who's buying a property that you are absolutely transparent with your mortgage broker and tell them your financial situation. Tell him or her your financial situation. That's absolutely critical, because the best brokers will go, okay, I now understand that, and there's nothing tricky in there, or there's nothing that's unknown to me. Therefore, I should be able to, or I will try my best to match you, Mr. or Mrs. Lender, with banks that are across this and you meet or match their policies. That's what the best mortgage brokers do. So if your mortgage broker's saying no, what do you say? Why?
Yeah, I'd say rather than saying, okay, I'll get another opinion, I'd really want to get them to tell you why. And if the reason is because of X, Y, Z, and it is something that you can then go to another broker or potentially one or two other brokers and say, my existing broker's told me no, or told me they can only get me this loan, or only get me this refi, or only get me this type of borrowing capacity because of these reasons. What they will do is at least say, okay, I've got a bit of heads up as to what you're talking about. I can then run it through potentially different lenders who have different policies, as well as look at different application styles and structures, which change the outcome exponentially a lot of the time.
So tell your broker everything. Tell them the full facts and all your financial information and anything else that's going on in your life, because a good broker will try to match you with a lender. And most brokers have 30, 40 plus lenders, and access to hundreds, if not thousands of different products.
Absolutely. Right? And they should, and really good brokers have good access to good BDMs. And a BDM's job is to tell the broker if they're unsure, a lender's BDM, to tell them potentially if the broker themselves are unsure, then the BDM knows their own bank's policies inside and out. So a good BDM should tell that broker to say, well, that person, they'll probably fit best in this type of product. So a good broker gets access to good BDMs because they're on different tiering, and that does allow them to actually get better information and far quicker as well.
Okay, that's good. So hopefully your broker is a good broker. But is there a point in time where you just go, I need a new broker?
Oh, absolutely. And I think it should happen to a lot of people. And this should really cut ties earlier rather than later. And if people are unsure of who and what to speak to, feel free to reach out to us. I mean, we don't do broking in-house personally and intentionally because we want to make sure we're working with experts, but feel free to reach out to us. We can put you in touch with a number of different people for any other various reasons.
How do people track you down?
Purepropertyinvestment.com. And they can literally just give us a call on the 1300 985428.
Okay.
Shoot us an email. They can catch us anytime.
Are you on the Facebook and the social media?
Instagram,
the
LinkedIn.
Book of Face,
yeah,
yes.
we put a lot of content out, especially around the brokerage side of things, around the current market side of things. We post literally on a daily basis on different market content. So we try to make sure it's not just vanity. It's really intention is education.
All right. Well, thank you, Paul. Appreciate your insights today.
Thanks for having me.
Hope you enjoyed that, everyone. 4 questions, and please send your questions through. The best place is editor@smartpropertyinvestment.com.au. We will get around to them. We want to do more of these as well. So send them through, and it's going to prompt our team to keep compiling all these together. And we try and make them a bit diverse. We get a lot of similar questions, so sometimes we'll aggregate them up. But for us, it's understanding what our listeners want, where they are in their property investment journey, and what sort of information we can deliver so they're better informed. Remember, smartpropertyinvestment.com.au. If you're not yet subscribing, social media stuff is Smart Property HQ, or the email every morning, smartpropertyinvestment.com.au/subscribe. Please, if you like what we're doing on the Smart Property Investment Show, big favour. It's just not me here behind the microphone. We have a really talented team of broadcast professionals who do all the heavy lifting when it comes to this podcast. They make me sound good and make me sound as though I know what I'm talking about. But maybe you've worked that out already. Please leave a review. If you think they're sort of 5 stars what we're doing, and that's great. And just leave a note as well. If you like what we're doing, we get a real kick out of it, and we share that, and we do read them. So we'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.